Hey guys, everything in my video is taken from Century 21 Accounting, and today we're going to be looking at lesson 9.2 in the textbook. So the first thing I'm going to do is kind of go over a basic review of what the chapter is about. So this chapter is learning about measuring inventory and accounting for merchandise purchases. So the first thing we have is this new concept of merchandise. We did not learn this in a sole proprietorship, but we're going to learn it in a merchandise company. So a list of assets, usually containing the value of individual items, is called an inventory. So those could be merchandise inventory. It's the goods a business has on hand for sale to customers. So anything from store supplies to clothing. What I mean by store supplies is like in Staples, you can go in and buy pencils, erasers, folders. Those are all merchandise or inventory. So it's the inventory. It's what the company has. So grocery store has fruits, vegetables, napkins, paper towels. They have to keep track of all of that information. So if they have 20 paper towels in their paper towel aisle, somebody has to keep track of all of that so that they can determine how many they started with and how many they sold. And so in the accounting world, somebody came up with these two methods for tracking inventory. And the first method is perpetual. The second method is periodic. For a perpetual inventory method, the business records both all of the increases, decreases, and the balance of each item that they have on hand. So, for example, at a store like Giant, they might record using a perpetual inventory. So they have barcodes on everything. And when they get paper towels, they might scan every paper towel roll, like if it's an individual pack or maybe it's like a 20 pack. So they scan that barcode and it shows, okay, we have one paper towel roll or one pack of paper towels. Then they get the second pack, scan it. Third pack, scan it. It's probably somebody's job. Then it gets put into a digital computer system. Then when you decide, hey, I'm going to buy this paper towel roll, you take it up to the cash register and they scan the same barcode, and in their inventory it shows, okay, now we're down to 19 paper towel rolls rather than the 20. So this is constant, and you can tell easily what the current quality on hand is when you use the perpetual inventory method. So this is more the bigger companies. I don't believe that mom and pop stores would have something like a perpetual, but more of the bigger companies that can afford a digital online tracking system. And so when you have a perpetual inventory system, purchases of the merchandise are accounted for directly in the merchandise inventory account. So you record everything in an account called merchandise inventory. Now on to the periodic method. Well, what do you think periodic method is? It is based on the period. So merchandise inventory evaluated at the end of a fiscal period. Could be the end of the month, could be the end of the day, could be the end of the year, could be a quarter. Every 6 months they might count their inventory, but somebody sits down and physically counts how many paper towel rolls do we have? How many shirts left do we have? And they write it down on a piece of paper. They write it down in a catalog. They write it down on a computer. And they physically count how much is on hand, a physical inventory. So that's the periodic method versus the perpetual. Companies can choose what they want to use, when they want to use it, but they should be and stay pretty consistent with it. The next is cost of goods sold. So the first is just what method do we want to use? Do we want to use perpetual or periodic? Then we have this new cost of merchandise. So the amount a business pays for goods it purchases to sell is the cost of the merchandise. So the cost of merchandise can include, a company buys these roll of paper towels from I don't know, maybe Giant buys their roll of paper towels from Paper Towel World. They buy 20 paper towels or 20,000 boxes of paper towels. Well, they have to pay the shipping expense. So that's a cost of merchandise. So they have to add that into every paper towel roll. That, in accounting, is considered freight. We call shipping expenses freight. So when you buy merchandise as a business, we buy inventory from someone, we need to account for how much the freight cost was, so that when we sell it, we can sell it for more and we can make a profit. So when a periodic inventory system is used, the cost of merchandise is recorded right in this new purchases account. So this is a new account that we're learning, and it is purchases. So we need to record anything that we buy in this purchases account. So we have the debit increase, the normal balance, and the credit decrease. So anytime we buy something for purchases, we have to record it in the purchases account. The cost of merchandise is recorded in this account for the periodic inventory system. It's different for the perpetual system. So the only thing that's recorded in the purchases account is anything that we plan on reselling, not like store supplies like cleaning stuff or extra pencils for us at our desk or notepads for our employees. No, just things that we're reselling. If we bought additional stuff that we use for the company, that's recorded in the supplies account, not the purchases account. We'll go over what it looks like in the income statement later when we show the example. This section up here just says that when you are purchasing something, you need to include the freight cost. But if you are selling something, and again, freight is the shipping, if you're selling something, you record that in freight expense. So when we buy something, we record it in our purchases, but when we're selling something, we sell it in freight expense. We record it in freight expense. We will address that a little bit later on. Otherwise, down here, this section is the cost of merchandise sold should appear on the income statement only when the goods are actually sold. This would be good for you guys to read. For a business using the perpetual inventory method, the cost of merchandise is recorded in the merchandise inventory account until the goods are sold. So whereas for the periodic, they're just recorded right in the purchases account, the perpetual, there's another account that's used. It is the merchandise inventory account. And then they're put into the cost of goods sold section. We will do a problem relating to that. Finally, on this page, we see what it's like to order merchandise. So a form requesting to purchase merchandise is called a purchase order. So we might send this to a company and say, hey, here's what we want to buy from you. This was probably 20 years ago. Now we do everything online. So you can process an order right online from somebody most of the time, unless a company is still kind of... maybe they're not a massive company and they still sell stuff, then they pretty much would do a purchase order. They would put in their request to buy stuff, and then you'd send it in and they would say, okay, we'll put this in our system and we'll send you your item. So we put in a purchase order. And then we're going to get into using special journals. In this chapter, we're just going to talk about purchases journals and cash payments journals, but there's 5 special journals that we're going to learn about in chapters 9 through 11. We already learned about the general journal. If you go back to the first chapter, that general journal is where we recorded everything. We just journaled. First step of the accounting process, journal what you've got. For this chapter, we're going to learn about purchases journal. Purchasing journals is where you record any purchases. That's a special journal. Cash payments, where you record any cash payments. So if something comes up that it's like paid cash for that would go in the cash payments journal. Sales journal is where you record the sales. Cash receipts is where you record cash receipts. General is where you record everything else. 5 journals, 5 special journals. And a special journal is a journal used to record only one kind of transaction. In a massive business like Nike, this helps organize their information. Rather than recording everything in a general journal like we would do in a small business, this helps keep their information kind of more organized. So up top here, we can see what a purchases journal looks like. We have the date, account credited, and 2 columns right here. Well, 1 column, but 2 account titles in this column. This is called a special amount column. As you can see, it says purchases debited and accounts payable credited. Because if you make a purchase on account, that's what's going to happen. You're going to debit the purchases and credit the accounts payable. This makes our lives a little bit easier. It's just 1 column because that's what happens. We purchase something, so we debit it, and we show the increase in that purchases account, and we bought it on account, so underneath here it says accounts payable, and so that's always credited because it's a liability. So we have the purchases journal that we're going to learn about in this chapter. Down here it talks about a purchase invoice. So once we make that purchase order, we request for items to be sent to us, the company will send us an invoice, and usually on that invoice we see a terms of sales and we see the due date. So let's see, here's the shipping date, here is the delivery date, and here's the terms of the sales. This means net 30. So it means the full amount is due in 30 days. When you see net is the full amount, whatever it is due in 30 days. And the payment due date is the 4th. So finally, the last thing on this page is just an example. Purchase merchandise on account from Win Lighting for $1,082.50. So we do the same thing. We put the date. We're buying on account from Win Lighting, so that's the account that's credited. Our document number is 525, and the account is 1,000, or the number is 1,082.50. So this is kind of good to look over. We know that the accounts payable is to Win Lighting, so we don't even have to write accounts payable because it says accounts payable up here. Look through this textbook, and then we will move on to doing the journalized problem in the next video. Thanks for listening.